Hello traders. In today's video, we are going to explore in-depth few smart money concepts, entry setups, and exit setups. And as well as going into explaining the details in form of pros of every strategy and concept, and the cons of each strategy and concept when it's about entry model executions in the financial markets. We will go into detail of high probability trading opportunities with as much optimization as possible for you to have highest chances of becoming a profitable trader. If that is something you're interested, leave a like, a subscribe, and most importantly, leave feedback in the comments. Now let's get started. We start from learning to recognize, plan, and use optimal entries. It is logical that we make a plan before we enter a position. An optimal entry should maximize the potential profit, making as much money the possible setup can hold on to. An optimal entry should help to minimize the risk in such way that we position ourselves into the right side of the market to have more winning trades than lost ones. This, of course, could lead into having a higher win rate or better profit factor. The optimal entry also allows traders to manage the risk by controlling the position size based on many factors like the trend, being aware of upcoming news events with big high impact on the liquidity and so on. And finally, it enforces and builds discipline, making traders to take action based on their rules instead of their emotions. Not having a plan or building up the plan after the position execution could lead to substantial losses, so be careful and don't force trades. If you feel that you can't control yourself, switch to a higher time frame that allows a more slow and patient approach. We start by analyzing the following chart. Initially, the euro-dollar was in an aggressive uptrend, continuously breaking former highs. The loss of momentum is shown by the sideways consolidating market. The price firstly breaks the consolidation up, but comes all the way back down. That is a sweep of liquidity, a trap smart money usually does to confuse traders. The market shortly after broke to the downside with significant volume. Look at the candles, lack of wicks and constant perfect downside. Such candles indicate that an inefficiency has been formed and price should retrace back up to fill some more orders, to keep a good momentum and a lot volume, because the market usually hates a lack of liquidity because it can't properly move without filling orders and confuses most of participants. The inefficiency, often also called as imbalance, can be filled via a fair value gap, but there isn't a valid one there. We can also take the Fibonacci retracement, since this move is a retracement, and the rejection happens exactly at the 0.6 weight zone, often named as being the golden pocket. You could use the Fibonacci as an entry strategy, or you can just implement it just to be aware of potential upcoming moves. Like these type of rejections can indicate the current trend of the market. After setting the high, the upcoming uptrend movement couldn't break an important high, and instead manages to break previous set low, confirming the bearish break of structure. Let's move to the next candles. So after the bearish of structure, the market kept crashing, essentially taking the liquidity of these levels. The trend of this market is a downtrend with no noticeable reversal indication. We also have this bearish order block in mind, in case prices goes to that level to mitigate it. A slight loss in momentum signals the loss of strength of the sellers. Up into this point, where the market has managed to break the first structure, see that it has broken the first important level. We would like to mark the high being broken on the chart so it is easier to notice. Now we will go to a lower time frame to observe this move more closely. So basically we have the same pattern as the past consolidation at the top. That time it was very hard to predict because the price was in a continuous uptrend. But this time, knowing that we are in a downtrend and we have higher probability of success, by following the larger time frame we can look for sell short opportunities. The highly liquid zones of this chart is the high that the market has just broke. This ascending channel also is a highly liquid level. And lastly, the low swing low levels. On a downtrend market, the liquidity is taken from the buyers to feed the move to the downside. So it is more likely that we can choose this level being a liquidity sweep than the bottom of the range. It has failed hold and quickly reversed down. That big red candle indicates sellers took control over the price. Rewinding the information we have gathered about this move, potentially being a liquidity sweep to take it lower, we can look to sell short right after the next up candle has filled some liquidity of the past red candle. The stop loss above the wick. and take profit. We are looking for the market to break lows of the structure. This was a more general and easy entry execution. Finding setups is one thing, but setting up the entry plan is important. Let's consider this being the high time frame structure, with a downtrend, a liquidity sweep, and a creation of the point of interest as an order block or demand zone, continued by breaks of structure to the downside and a formation of a micro uptrend. We have three main entry setups. The first is the aggressive trading model. This entry model is the riskiest one, because the loss is usually bigger than the other setups. This entry type is simply just entering a position based on the high time frame, executed in the high time frame. So that would be basically placing a sell limit order right at the touch of the point of interest, with the stop loss above that structure, and take profit to the low of the market. Let's see what are the pros and cons of this setup. A pro is that you will rarely miss an entry opportunity, and since it's a high time frame play, you can easily and patiently monitor and manage the position. The cons of this setup are represented by a higher risk with a wider stop loss, so the loss could hurt more. We also have a lack of detailed information from the lower time frame, so less confirmations and a potential to get trapped in a reversal. Another con is being in a position during high-impact news events that could change the market direction. For example, if the price went down but news like inflation came positive for the market, that market can reverse based on news data, making price action less predictable. The second entry model is the conservative trading model. In this trading model, we use both time frames. The high time frame is used to analyze the overall market trend and macro direction, and the lower time frame is used for entry confirmation and for the execution of trading positions. An important factor to remember is that your high time frame where you do the analysis should be at least 2 times higher than the time frame used for the entry execution. Let's demonstrate how the conservative model works using the same price action structure. As we have mentioned, this is the high time frame, and this time frame is used for analysis that we already have done before, so we are talking about looking for breaks of structures, fair value gaps, points of interest, liquidity levels, and such things. Now, knowing that price has mitigated the point of interest in the high time frame, we apply the conservative model of switching to a lower time frame for confirmation and execution. So we're going to take this price action and combine the continuation with a lower time frame, and it will look something like this. The red price action is the lower time frame action inside the high time frame. Don't forget that we are inside a bearish point of interest as an order block, price-forming bullish breaks of structure in the lower time frame. Then breaks down, creating the change of character. The aggressive push-down can leave an inefficiency or another smaller bearish block. So when price mitigates the zone, we can place a limit sell short at the lower time frame zone, with a stop loss above the low time frame structure, and the take profit below the high time frame structure. Just to make sure you understand, this is high time frame structural low, and therefore this is the take profit. This is only seen on the high time frame, but the execution was made in the low time frame. The pros of the conservative entry model. The execution is usually made, seeing a clear reaction after mitigating the point of interest. Seeing the reaction allows traders to potentially enter a trade right when the opportunity has hit, this providing a higher risk to reward ratio. So a win will be worth couple times more than one loss. Another pros is not needing to stay stuck in positions during high-impact news events. A con is that by switching on a lower time frame, you could be exposed more often to liquidity grabs or inefficient spreads, increasing the chance of the stop loss being hit. And the final con is missing many trading opportunities. You will probably have less trades, but with a higher quality setup. The final entry model is the hyper-conservative model. We take the same structure used before, so this is the high time frame structure. We take only the mitigation part to represent. The hyper-conservative model is based on price mitigating the high time frame point of interest and switching to a lower time frame to observe the potential change of character that forms another smaller point of interest by an order block or fair value gap. So far, this sounds like the conservative model. But at the mitigation of the smaller structure, we switch again to a lower time frame to observe the change of character inside the smallest point of interest. That change of character is usually followed by another fair value gap or order block. This zone being the entry for this trading model. the stop loss above the lowest time frame's point of interest and take profit at the low of the highest time frame structure. So the same take profit. The only change is the entry might be better and the stop loss should be tighter. What are the pros and cons for the hyper-conservative entry model? The pro is that we have more confirmation based on multiple time frames, so could lead to more valid trades. It also leads to a higher risk to reward ratio since the stop loss is usually smaller, so a winning trade way more valuable than a loss. And a lose streak can be all covered by a very few number of wins. The cons are that is very time-consuming and requires a lot of focus and mind power. It can also miss many trading opportunities since the entry is carefully selected. In our channel, we usually do the conservative model. It has a good balance of good market analysis and simple execution. The hyper-conservative might be too complicated and unnecessary in most situations, but can be applied to some certain setups in times of high liquidity, like the daily opens of a trading session. If you have learned the information provided in this video, you will be able to recognize trading opportunities and understand our incoming videos. All entry models are based on the 3 types we have mentioned. Stay tuned to our upcoming videos where we will apply these entry models into trades. Thank you for watching, and see you on the next video.